Hello, everyone. Thank you very much for joining us once again today and welcome back. What we are discussing today, as you all know, we are discussing today the latest guide published by the FTA, Determination of Taxable Income. There are 5 sections of the guide, and these 5 sections are specifically introduction, then overview, then key concepts, then case studies. So starting from glossary introduction, sorry, the first one is glossary introduction, overview, key concepts, and at the end case studies. In the glossary, they have provided a very, as usual, basic definition. The keyword there, it has been given along with this. They have provided the definitions as well. What is I think so many guides have been published today, and I think there's no requirement to go through the glossary. You all know this, what is taxable income, what are taxable profits, what is taxable person, exempt person, you know this. Then in the introduction, what is the purpose of introduction of this guide? Purpose is straightforward, to give more guidance, clarification to the taxpayers so that they will be able to prepare their return, and they will be able to submit their return properly. In the overview section, this is overview of the overall guide. In the overview section, they have given one very good template. This template is quite helpful for the taxable persons, how to prepare for their taxable return. We'll discuss this template, then we will not be focusing on the key concepts. We have already discussed so many times what are the key concepts, like what is small business relief, what is the entertainment expenses treatment, salaries treatment, tax loss treatment, how the losses can be carried forward, interest treatment. All these things we have discussed so many times. Quickly, we'll go through this. Our focus will remain on the case studies. We'll try to discuss all case studies today itself. Along with this, we'll discuss different concepts as well. So in this determine of taxable income, we have discussed in the very beginning, there are two different approaches to calculate the taxable income. One is the direct approach, second is the indirect approach. Direct approach is you can take your taxable supply starting from the sales, deducting cost of goods sold, deducting relevant allowable expenses, then you will arrive at the taxable income. Second is you are starting with the net accounting income. Based upon the net accounting income, you are reversing back, basically adding back the non-allowable expenses, and then you are arriving at the taxable income. So we concluded that in the law, the only one method is available. Option has been given, or there no option, only one method, and this method is indirect method. In based upon the indirect method, we need to prepare our financial statements. If the revenue is up to 3 million, you can apply the cash basis of accounting revenue. 3 to 50 million, you can apply IFRS for SMEs, and if the revenue is more than 50 million, then you need to apply the full-fledged IFRS. So far as audit is concerned, revenue is more than 50 million, audit is compulsory. If the revenue is less than 50 million, audit is not compulsory. So whatever concluded till now, that we need to take the bottom line of our financial statement, net profit, for accounting purposes, then we need to adjust that profit to arrive at the taxable profit. This template is specifically related to the same thing that we just discussed, indirect method of application to calculate the taxable income. They have taken accounting income for a taxable income, that they again basically unrealized gain or loss adjustment, because there is option to the taxable person. They can apply the realization basis, they can apply the unrealization, the basically accrual basis. Then exempt income, the income which is not subject to tax, needs to be deducted. We know the different exempt income. Dividend is exempt. This is some other profit, basically what is this called, investment. Is the 5% investment, that income is exempt as well. So along with this dividend, along with this participative exemption, participative investment, participation exemption income is exempt as well. Related dividend is exempt, subject to some certain conditions. Then we need to do adjustment non-deductible expenses as well, because all accounting expenses are not allowable for tax purpose, needs to be adjusted as well. After making these all adjustments, then TP adjustment as well might be you have made a transaction in between the related parties or with the connected person not at the market value, then the TP adjustment is there as well. So after making all these adjustments, you will arrive at the taxable income or taxable loss. Then based upon this, you will calculate your, then you can adjust the carry forward losses. That will look into this. After adjusting the carry forward losses, you will arrive at a taxable income. This taxable income, as I mentioned, you can calculate how much is the tax you will be liable to pay. So as a first step, you need to prepare your financial statement. Would you need to calculate your accounting income. Based upon the accounting income, you need to make the adjustment. This adjustment can be exempt income, non-related business expenses, reliefs, then non-allowable expenses, then there's a TP adjustment. After making all these adjustments, you will arrive at one number. That number needs to be adjusted with the carry forward tax losses. If the carry forward tax losses will be adjusted, then the remaining amount will be subject to tax up to 375,000. If you are not a qualifying free zone person, up to 375,000, 0% corporate tax. Beyond that, 9% corporate tax is applicable. This is a template that you need to follow while calculating your taxable income. So we'll look into the various case studies as well, the application of this template. One important thing they have given here, that while adjusting, suppose you have calculated your taxable income. Based upon this, you apply the tax. And then once you apply the tax, after applying the tax, what is the payable out of the payable? First of all, withholding tax will be adjusted. Then they said it will be followed by the foreign tax credit. The foreign tax credit will be adjusted later on, and withholding tax, if any, it will be adjusted first, then foreign tax will be adjusted. The same thing they are given over here as well. Overview of the case studies, 9 case studies as we discussed. We'll be going through in detail with these case studies. Determination of taxable income and calculation of taxable income. Key points, starting point we have already discussed. What is the starting point? Starting point is accounting income. Tax period, it can be adjusted from maximum up to 18 months and minimum up to 6 months. We cannot, tax period cannot be less than 6 months and more than 18 months. Unrealized gain and losses, if the businesses are preparing their financial statement on accrual basis, they have an option that if they wanted to, they can tax their gain and loss on realization basis, means when the assets or liability will be sold or settled instead of accrual basis. If they are opting it, they need to opt it before the submission of the first return. This is the requirement. If financial statement has been prepared on accrual basis and gain and loss adjustment, it will be required the adjustment. Election, they can make the election. Exempt income that is not subject to tax, as we discussed earlier. Dividend is there, participation exemption is there, various other income given in the law that are not subject to corporate tax, but it will be accounting income. It needs to be adjusted. Their domestic dividend, participation exemption, they are subject to some certain conditions. These are not subject to tax. Foreign PE can be exempt as well. If you have foreign PE, as it is given in the law, that you have an option to make an election that the foreign PE and all their related income expenses, it should not be considered for tax purposes in the UAE. And if you are making this election, it will be applicable on the all foreign PE that has been given in the law. You cannot pick and choose. This is the basically exemption. If you are taking that exemption, you need to remove everything, means income expenses of the foreign PE while calculating the taxable income. We will see the application of this thing. Deductible and non-deductible expenses. We know some expenses are deductible, some expenses are not deductible, like interest. You can claim maximum up to, if the interest is up to 12 million, you can claim 100%. If this is beyond 12 million, you can claim 12 million or 30% of EBITDA, whichever is higher. If you are taken a loan before 2020, December 2022, I can't remember the exact date. I think this is 14th of December or 13th of December, something like this. If you're taking loan before that date, there are no changes in the term and condition of the loan, then you can claim 100% interest. Otherwise, you cannot claim. In the same way, if this loan conditions are not applicable on the banks, financial institutions, and natural person. And equip qualifying infrastructure product, you can claim 100% interest as well. So this is basically accounting treatment is different for some expenses, tax treatment is different, like the entertainment expenses. For employees, you can claim 100%. For other than employee, you can claim only 50%. Then you need to make the adjustment. So basically, you need to make the adjustment for allowable and non-allowable business expenses. The non-allowable you cannot claim. Only expenses related to the business you can claim, and subject to rules and condition. It has been given in the guide. Employee related expenditure we are already highlighted. I have already highlighted. This is important line. If the expenditure might be the one expenses you are, this is common expenses you are incurring for business as well as for the personal use, and you cannot differentiate in between the business and personal use, then the losses, then it will not be allowed for deduction purposes in the corporate tax. Arm length adjustment will be there. Non-deductible capital expenditure like plant and machinery, these are capital expenses you cannot claim in while calculating a taxable profit, but you can claim their depreciation amortization. Reversal, bad debts provision. If you have created the provision, this is allowed for the bad debts, and when this will be written off, that will be allowed. And if you are reversing the provision, the time provision is being reversed, it will be subject to tax at that time. This line is important. If you've already created the provision before the implementation of the corporate tax, before entering into a tax era, you already created the provision and now you are reversing the provision after entering into the tax era, that provision will be subject to tax as well. Non-deductible expenses, the comprehensive list has been given in the law. They have reproduced it here as well, like which expenses are allowed, which expenses are not allowed. Entertainment expenditure 50%, employee related 100% allowed, incidental and commercial hospitality. Commercial hospitality means you are using pantry item in the office. Pantry item is allowed straightforward 100%. Marketing and advertising expenditure is allowed. Interest, we have already discussed what is the principle, what are the rules for the interest. How can you calculate this? Is they have given the table. Basically, net interest rules are applicable on the net interest expenses. While calculating the net interest, you will not be required to include the interest for the loan that you have taken before December 2022, because you can claim 100% loan that you have taken quick qualifying infrastructure product. You will not be including. If the individual person 100%, they will become banks, financial institution, they will not be including. Basically, whatever the loan that you can claim 100%, then interest limitation rules are not applicable on that loan, and that will not be added while calculating the net interest on which these rules are applicable. We'll see the application. Tax losses relief. What is the tax loss relief? Losses, if you are facing tax losses, you can carry forward tax losses for unlimited period of time, but maximum up to 75% of the taxable income. Whatever your taxable income, you can adjust their carry forward losses up to 75% of the taxable income of that period. Remaining will be adjusted against the tax losses. Means on every year, at least 25% of your taxable income will be subject to tax. Then you can adjust the out of the taxable income, you can calculate the tax, and after calculating the tax, you can adjust the carry forward, sorry, you can adjust the withholding tax, and you can adjust the foreign tax credit, and then you will be liable to pay the net amount. This is subject to some certain condition. Two conditions: there should be a continuity of business, there should be continuity of ownership. Then the losses you will be able to carry forward, otherwise you cannot carry forward the losses. You can transfer the losses 1%, because if there's a common ownership, minimum up to 75%, you have a common ownership of 75%. Then lot of other condition, like they're the juridical person, same financial year, so same accounting period, none of them is exempt, none of them is a qualifying free zone person. Then one business can transfer their tax losses to another business, and these losses can be transferred maximum up to 75% of the taxable income of the taxable person to whom the losses are being transferred. It cannot be transferred more than this. We will see the application. Tax credits, I have already discussed. Tax credit, you can take the foreign tax credit after the withholding tax, but these tax credit you cannot carry forward, carried back. You need to be adjusted in the same tax period, otherwise it will be lapsed. Then they have given how to calculate the tax credit. You can go through this. Coming back to the case studies, we will be discussing focus. As I mentioned, our focus will be on the case studies. First case study, deductible and non-deductible expenditure. If you are going through this case study, you can go through this. This is a company F, UAE company, wholly owned subsidiary company Q. Company Q key senior personnel is, there is a one personnel proportion is 70% time working for the company, 30%. Basically, company F, this company F, one senior personnel, 30% of the time of the senior personnel is going for the non-business use, 70% for the business use. Now they are given further information as well. This information is revenue of the company, expenditure, cost of goods sold. This is all this employee related expenses. This is basically, what is this exactly? This is your profit and loss account that you've taken from the financial statement. This is what I was asking. Financial statement preparation is compulsory for every business. Audit is not compulsory, less than 50 million revenue, but the financial statement preparation is compulsory. You can use cash basis, accrual basis. Up to 3 million, you can use the cash basis. Beyond 3 million, you cannot use the cash basis. You can use only accrual basis. So this is the basically bottom line. This is, you can say the numbers have been taken from the profit and loss account of the financial statement. So total accounting income is 12760. If you're considering the accounting income, you need to make the adjustment. What type of adjustment? We can go through this adjustment very quickly. So if I'm asking, that is 12760 is my profit. If this profit is, and this provision fund fine and penalties, for sure this is not allowed because fines and penalties are not allowed. I am adding it back. Provision for customer warranty, provision for bad debt, this is fine. Pre-incorporation expenses, this is allowed for tax. Contribution to private pension fund. Private pension fund, they said maximum up to 15%. 15% is allowed. Beyond that, this is not allowed. Contribution to the private pension fund, they said out of this 3 million, 1 million remain unpaid. This is allowed on payment basis. 1 million even has not been paid. Whatever it has not been paid, we cannot claim. I'm adding it back. So 1 million added back, we can claim this. Rent we can claim. Bribes we cannot claim. 2 million, I'm adding it back. Okay, then the fines and penalties, speeding, over speeding, fines and penalties we cannot claim for sure. I'm adding it back. Breach of the contract. This is a business expense. You are doing day-to-day business. You breach a contract, but this is normal business expense. You can claim. Customer compensation you can claim. Professional fee for defending legal claims by customer, that is fine as well because this is a business expense. Donation and gift, qualifying public, and this has been given in the exempt income, and this is if you are making sorry, in the expenses, if you are making any donation contribution to the registered qualifying public benefit entities, you can claim, and any other this you cannot claim because these are not registered, then you need to add it back. I'm adding it back, 700,000. So entertainment expenses for employees you can claim, as we discussed. Entertainment for business partner you can claim 50%. 50% will be added back, so I'm adding 250. Entertainment expenses, shareholders, family members. Family member is a non-business expense. Altogether it needs to be added back. Employee travel expenditure during business days, during non-business days, objective. I am assuming even during the non-business day, they are working for business. We are claiming it. Other purchases. Software is business use is fine. This is not the right to use for 1 year. Within 1 year, this is not a capital expenditure you can claim. Low value items, medical life 2 years. We are assuming this is revenue nature item. We can claim 100%. Item purchase for subsidiary because this is not your business expense. This is a subsidiary business expense. I'm adding it back. 700,000. I'm adding back. Local taxes, property and municipal tax related to the business you can claim. Employee benefit for home working. Assuming employees are thoroughly working for the business from home, we can claim. Then Cost of goods sold, you can claim salaries and wages, bonus, all these things. For employees, you can claim to director who are shareholders. You are giving them director. I'm assuming this is at the market value, so we can claim shared employee cost. Shared employee cost they have given in this paragraph. Shared employee 70% for the business use, 30% spent to company Q, means charitable purposes, not for business purposes. So 70% of 200,000 we should not claim, which is equal to 600,000. So I'm adding 600,000 back. So my answer is coming 19.230. So 19.230, this is my taxable income. As we discussed, we make all adjustment. We have taken what we have taken. We have taken the accounting profits, make the all adjustment, arrive at the taxable profits. Is there any carry forward tax losses? No, not given in this question. So up to 0%, 300, then 9%. This is your taxable income. I believe everybody will be clear on this. Quickly, we can jump to the next. You can go through all these notes because time is very limited. So I'm going through very quickly. Interest expenditure, this is facts. Facts is company J. The company J, there's 100% own company G. Company G own company H out of UAE, and company G owns company I out of UAE. Here this is 6% holding. Here this is 100% withholding. So it owns 6% of the shares in company H. एक resident incorporated tax resident. Company H is the participation interest of company G. This is important. Participating interest of company G. H means 6%, whatever it is being held, all those conditions, we are assuming there are 4 or 5 conditions: 5% shareholding, uninterrupted period of 12 months, 9% tax in the relevant jurisdiction. And all these conditions, we are assuming these conditions are being fulfilled. This is a participation interest, satisfying all the conditions. During the company G, loan, wholly owned subsidiary, I, the company G has taken a loan from the I. A company incorporated in tax resident company country not done 9% tax is not applicable. You need to keep in mind that whenever we are taking a loan from the company and this loan is being taken from the related party, and this loan is being used to pay the dividend or profit redemption or the share redemption, then we cannot claim that interest unless and until this party, the lender, is subject to tax at 9%. Lender is not subject to tax at 9%. In this paragraph, they have given this loan is being used making a payment of dividend funded by loan from company I. Dividend payment means whatever the loan that is being given by I to G, this loan will not be claimable in the books of G because it will be considered tax planning to avoid the tax, because I is not subject to 9% and loan is being used to pay the dividend. They're asking to calculate the taxable income. Again, they have given the revenue profit and loss account. I will calculate for the 1 year. You can calculate for the second year. So for the first year, what is your accounting income? 12 million. 12 million is the accounting income. This is the profit. Okay. Interest loan from company I, as we already discussed, because this loan is being taken from a related party and being used to pay the dividend. Related party from which the party we are taking the loan, that is not subject to tax at least 9%. So we cannot claim this. I'm adding 28,000 back. Guarantee fee not related to the loan. This is a normal loan, interest expense, normal loan. We can claim maximum up to 12 million or 30% of EBITDA. If the loan amount is less than 10 million, we can claim 100%. We will have a separate calculation for it. Interest expense. This loan has been taken before 2022. Then we can claim 100%. We are assuming there are no changes in the term and condition of the loan. Interest. Amortization of development is fine. Depreciation of assets is fine. Professional fee for acquisition of H. Now H, we are assuming that H, we meeting all conditions, and once all participation conditions are being met, then any income will not be subject to tax. Losses will be allowed as well. So we should not claim this professional fee because this is directly related to your participation exemption. So I'm adding it back. 7500. General expenses are fine, salaries and wages are fine, cost of goods sold is fine. This interest income, we need to apply a net interest basis dividend from the company H. This dividend should not be subject to tax. So my income dividend should not be subject to tax because this is under the participation exemption, conditions are being satisfied. So this is 27.5 million. This before deduction of interest, my number is 27.5 million. Before interest, now I need to do the interest calculation. How can I do the interest calculation? Interest is straightforward. We need to assess if this is less than 12 million, we need to claim 100%. If this is more than 12 million, then net interest and 30% of EBITDA, whichever is higher, we need to claim. So before interest, before number is 27.5 million. Now I need to calculate the interest. My interest income and interest expense. This interest expense 10 million. Because this 2 million we have already, because this is allowed 100%, I should not include in the calculations of interest. Then this is 30 million more interest, 2.5 million more, then 22.5 million more, then 1 million more. So it total is coming 66 million. 66 million, then I need to reject this adjust interest income 20 million less 12 million. My interest is coming 30, net interest is coming 34 million. 34 million, which is more than 12 million. So I need to apply the rule. 12 million or 30% of EBITDA, whichever is higher. So net interest is coming 34 million. Then I need to calculate the adjusted EBITDA. Adjusted EBITDA. Earning before interest, tax, and depreciation. Then I need to calculate 30% of adjusted EBITDA. So my adjusted EBITDA is, I can apply the direct method or indirect method. Here I'm applying direct method. In your guide, it has been given indirect method. I'm applying direct method. Trading income is how much? 150 million. Dividend income, I should not consider. Interest, I should not consider. Cost of goods sold, less cost of goods sold, less 50 million salaries and wages, less general expenses 7.5 million. Professional fee I should not consider because this is not allowable. Depreciation not allowable, should not be considered. Adjusted EBITDA, amortization not be considered. So this is coming 67.5 million. 67.5 million is my adjusted EBITDA into 30%. 65 into 67500 multiply 0.3. This is coming 20250. So 20250, 20.25 million or 12 million, whichever is higher, 20.25 million is higher, then I need to deduct this 2250 and my taxable income should be 27500. It should be 7250. So how much is my taxable income? Taxable income is coming. My taxable income should be, as per my calculation, it should be, no, we made some mistake. So what I did basically, I take an accounting income. Okay, let me do it one again quickly. 12 million is my accounting income. 12 million, then I need to add it back 28,000. Then I need to amortization of development 1 million. Depreciation of fixed assets is allowed. Professional fee is not allowed. Professional fee is not allowed. This is allowed. This is allowed. This is allowed. This is not allowed. 27.27500. Then net interest. Net interest should be 30% of adjusted EBITDA. Net interest expenditure, they are asking, this is, so net interest expenditure should be adjusted EBITDA. Adjusted EBITDA is, so let me go to the calculation. Yeah, this is fine. 34 million is fine. We have calculated the same net interest expenditure as well. Adjusted EBITDA I have calculated 6-7. Adjusted EBITDA is fine as well. So 20250, that is fine as well. So 20250 is my allowable adjusted EBITDA. 30% of adjusted 20250, and my net interest is 34, whichever is higher. Adjusted EBITDA 20250 should be deducted. 34 million. Here I made the mistake. They are asking, sorry, not 34. This is fine as well. 50 million. Where I made a mistake. That is basically everything is correct. Anyway, this is might be a calculation error. It should have been same principally. So 27500 minus 20250. 275 27.5 million into 20250. Just look into this. Might be we have made there's some error here. It should have not been. So that is fine. This is fine. This is fine. 20250 adjusted EBITDA. This is fine. This is fine. Net interest expenditure should carry forward. This is okay. This is for the next year. So if I'm going through 12 million plus 28 million plus 28 million plus 7.5 million less my dividend income 20 million. Okay, okay. We need to add back this interest as well. Altogether, we need to add back. Then we need to adjust because this interest has already been deducted. So if I'm going this calculation once again, I'm putting 12 million plus 28 million plus 1 million plus 22500 plus 2500 plus 30 million plus 10 million less 20 million less 12 million less 20250. No. Okay, I'll check this once again where I'm making this error. The basically principle and concept is same. We need to take this net accounting income. We need to make all the adjustment. We have done the right calculation for the adjusted EBITDA. All these things might be discussing in a coming webinar. I'm jumping quickly to the next case study, and the next case study is so surprising that I'm not able to go through this. 12 million, 28 million, 12 million. This interest expense from company it should be added back. Yes. Then this should be added back, added back, added back. 12 million plus 28 million plus 1 million plus 22500 plus 2500 plus 30 million plus 10 million plus 7500 less 20 million less 20 million less 12 million less 20250 41250. Yeah, this is correct. So basically, whatever they did, they make this on net interest expense. What you need to do, you need to keep everything plain. Just take this 12 million. After this 12 million, you need to add back this 28 million. This is not allowable, not allowable, not allowable, not allowable. This is allowable, this is fine. This is not allowable, you need to add it back. This is fine, this is fine, this is not allowable. Then you need to go back. This should not be subject to tax because we are taking net interest separately, which is equal to 20250. So it will be deducted, it will be deducted, it will be deducted. After making all this adjustment, what are the remaining is coming? Out of that, you need to deduct the interest, that is 20250 that we have calculated, and your answer will be 41250. Anyway, sorry for this, I have taken your time. So coming back to for the second year, you can go through this by yourself. Tax loss relief. For the tax loss relief, we know this 75% of the taxable profit can be adjusted. The remaining can be carried forward. If you are going into this is a company K, branch in country L. This is the branch. Now this is a branch. They are asking me election. K made an election for the foreign PE branch exemption. If you are making election, means you should not consider the income, expenses, anything directly related to that branch. That will remaining will be subject to tax. So this is again profit and loss account 25-26. This is a loss, by the way. Loss, and this include branch impact as well. So we need to eliminate the branch income and branch expenses because we have taken exemption. So we can take loss is 16050. 16050. This is my loss. I need to eliminate branch, and branch loss is 2550. If I'm removing this branch loss 2550, so my 16050 negative 16050, I'm removing this 2550. Remaining loss is coming after eliminating 13500. Now this trade license, this 50,000 is already given here. I mean, this has already been considered. 5 million marketing, depreciation, entertainment, this is already given here as well. This 1 million, so we already considered. So sales is budget, written off obsolete stock, that is fine, cost of goods sold. So 13500 exactly is same on a calculator as well. So what we did, we have taken the overall net profit including branch. Then we have removed the branch income and expenses. Remaining is the taxable loss. Out of this taxable loss for the next year, 75% of this income can be adjusted. The 75%, this is a next year profit. Up to 75% taxable income, this loss can be adjusted. Remaining loss will be there. So we can say 1313500 less 9375. Remaining loss is 4125. It will be carried forward. This is the 25% of this year taxable income. That's why I was saying in the lecture in just couple of days before, a couple of moment before as well. So at least you will be liable to pay tax on the 25% of your taxable income. This is 100%, 75% adjusted in the carry forward losses. 25% is there. You need to pay tax on the 25% of the remaining taxable income. Interest expenditure and tax loss relief. Now they have given the interest expenditure and tax loss relief as well, both of the things in this example. N is a company incorporated in and tax resident in the UAE. Hospitality industry. Accrual basis financial statement. Okay. They are asking to calculate the taxable income. So again, I need to take this accounting income. This is a loss, by the way, accounting loss. 32500. Interest, we need to look into this. If it is less than 12 million, we need to claim. Otherwise, we need to claim adjusted EBITDA as I told earlier as well. So I need 19 million. General expenses, fire and amortizing debt, cost of goods sold, interest income for the bank deposits. Income. So 17 million. So let me do one less 32500 plus 19 million less 3500. 17 million. This 17 million. So how much interest we can claim? Interest we can claim 12 million or 30% of adjusted EBITDA. So 12 million, or if my interest is more than 12 million, then I need to apply this rule. Interest here is more than 12 million because 19 million is my interest expense less 3500. My interest is 15,500 net interest. 15,500, 15.5 million is my net interest. I need to claim only 30% of EBITDA or 12 million, whichever is higher. So I need to calculate my adjusted EBITDA. Adjusted EBITDA, I can apply the direct method. 1110 minus 64 minus 54. Adjusted EBITDA is negative, negative 9. When my adjusted EBITDA is negative 9, so I can claim 12 million or 0, or maximum I can claim 12 million. So 12 million I can claim. So once I'm claiming 12 million, my already loss is 17 million before that. 12 million is my further interest. So totally 29 million loss for the coming year. This loss will be adjusted in the future tax period against the future taxable income, but maximum 75% of that year taxable income. So a loss is from 29 million. Yes, this is a 29 million. And this can be adjusted next year. And next year, this income is 30 million. 30 million into 75%, 2250. Remaining this 25 million will be subject to tax in the same year, and loss will carry forward loss. Out of this 29 million, this 22500 has been adjusted. Differential will should be 29 less 22. This is the carry forward loss, 6.5 million. You can go through this description. Explanatory notes, you can go through this. Transfer of tax losses, limitation on tax carry forward losses. Now A and B, they owns company O. Company O, 100% owner of company P then, and 50% holder of company Q. Indirectly, O owns Q as well because O owns P 100%, P owns 50% of Q. So at the end, Q owns directly 50%. Oh, sorry, O owns directly 50% of Q and indirectly 50% of Q. At the end, O owns 100% of Q and 100% of P. The owners are A and B. This is a loss 40 million. This is the first year. They're asking this loss can be adjusted against the other company. They are adjusting the losses as well. So, but it will be adjusted 75% of this taxable income, 75% of this taxable income. So 15 million into 75% can be adjusted. 15 million into 75% can be adjusted. Double 11 double 250. Remaining loss will be 40 million 28750. Then next year, again, it can be adjusted up to 75%, 75%, 75%. So my remaining loss is 28750, 75% is 14 million, 14 plus 8, 22 million. 22 million into 75%. Further loss adjusted of 16500, remaining loss is 28750, sorry, 28750 less 16500, remaining loss is 12250. So third year the ownership change. In the third year, if you are going into the detail of this, they said in 2026 ownership change, they're not under the qualifying group. Once the qualifying group is over, they cannot adjust the losses. They can only adjust the losses if they're a qualifying group, at least 75% holding, all the conditions are being satisfied. So my remaining loss is 12250. My remaining loss is 12250. This will be carry forward. As I mentioned earlier, if you are going into this is the first year, 2024, 75% adjusted, 75% adjusted. Remaining loss was 28750. 28750, rest has been adjusted. Next year, 75, 75, 75. Remaining loss was 12250. This is the remaining loss. This is loss adjustment. Third year, they cannot adjust the losses. The reason is because they are not under the common ownership of it, at least 75%. So they are not part of the qualifying group. So third year, they cannot adjust the losses. This is what they're trying to communicate in this case study. Cash basis of accounting. We all know this, where we can apply the cash basis of accounting, where the revenue is less than 30 million, we can apply the cash basis of accounting. Once we are applying cash basis of accounting, all my income expenses will be subject to tax, or it will be allowable only upon the payment of cash. So in this example, they have given this company V has not elected for the small business relief. Okay, they have not elected. We'll go in your calendar. This is basically, again, the profit and loss is given. If I'm taking 577050, interest paid on loans, interest paid on loans. It runs a travel agency. Company B runs a travel agency, cash basis of accounting, elected for small business relief. Okay, actual receipts. The loan is less than 12 million, they can claim 100%. If there is a natural person, then loan conditions are not applicable. I'm assuming they are not natural person. So loan is less than 12 million, they can claim 100%. Okay, I'm taking it. 577050. Loan they can claim on cash basis is fine. Amount paid for the purchase of new computer, that is fine. Entertainment expenses for employees, they can claim 100%. For business partner, they can claim 50%. To 50%, we need to add it back, which is equal to 20300. We have added it back. Contribution to private pension fund, 15% allowed. Beyond that, this is not allowed. They are asking 130 out of the 130. Even this is not been made. This is allowed on payment basis. 130 even has not been paid out of this 181250. One is not been paid, then we need to add it back. It will be allowed on payment basis. 1/3, 135,000 added back. Rent pertaining to 25-26 payment basis, because it has been paid now, this is allowed. Salary, wages and bonus paid in 2025 even pertains to 24-20. It doesn't matter. Whenever this is paying, this is paid allowed. Paid in 25, this is allowed in 25. This is fine. Amount received from the sale of old computer, that is fine as well, received now. Dividend received from the company W, a UAE company, assuming this is a resident juridical person, should be exempt. So it should be not be subject to tax. It has been removed. Revenue pertaining to services rendered and received in 25, that is fine. To be rendered in 25, payment received now, that is fine, because we are following cash basis of accounting. Rendered in 2024, late payment received, that is fine as well, because received in this period. So the result is coming basically 682350. Yeah, 682350. This is their taxable profit up to 375%, 0%, beyond that 9%. You can go through the explanatory own notes as well. And this is a lost time is limited. We have only 10 minutes. So I will go through 7B. I will not go through. You can go through by yourself. Then we'll go to the last one. Unrealized gain and losses. Company A owns B, C, and D. B 100%. This is their subsidiary. C and D. This is the participation exemption. They are following. They have opted for the realization basis. It has been given here. We need to make the adjustment because the financials has been prepared on accrual basis. They need to follow the realization basis, and we need to make the adjustment. Accounting income is 7900. This is my profit. Cost of acquiring shares in C and D, it should be added because if revenue is not subject to tax, related expenses should not be allowed. Impairment loss on company D, losses should not be allowed. Unrealized loss on inventory should not be allowed because we are following realization basis. Depreciation of capital expenditure, professional fee paid to connected person, not at, because this transaction is not on arm length basis. Tax authorities will not allow it. It should be added back. Depreciation of item other than monetary below, that is fine. General salaries, cost of goods sold, that is fine. Unrealized gain on land. Unrealized, it should not be subject to tax. It should be removed. Dividend from company B and C, both are falling under the participation exemption. B, this is local dividend. C is under the participation exemption. Both dividends should not be subject to tax. So this is coming 9.5 million. So this is correct, 9.5 million. This is your taxable income. You need to apply tax. In this example, you can go through this. Basically, now they assumed one company is a branch. Out of this, then they have to change the treatment, the modification in the same example. You can go through this by yourself. They are assuming UAE is a branch. Then, but this is a foreign branch. Once is a foreign branch, we should not consider the income and expense. We need to remove it. Then we need to calculate the same thing. They have done it over here as well. You can go through this. Not made election fund foreign PE. If they are not made in election, then it will be subject to tax. If you have branch out of the UAE, you are not made for the foreign election, the branch will be treated as a separate company. Then you need to consider all income expenses. You need to calculate the income expenses of that branch as per the UE law. This is very important. You cannot rely on the financial statement provided to you by the branch. No. You need to take the numbers, convert those numbers, prepare the financial statement as per the applicable standard as per UAE. Then you need to calculate the taxable profit as per UAE. Everything will be exactly as per the UAE law. Just the branch will be existing outside the UAE, but everything will be as per the UAE law. Non-resident person conducting business in the UAE. This is last case study, and we have only 5-6 minutes. And the non-resident person conducting business in the UAE, once the non-resident person conducting business in the UAE, any income related to that PE of the non-resident person is subject to tax in the UAE. Any income, any expenses out of the UAE not related to that PE, it will not be subject to tax in the UAE. So this is company N. Company N, a resident incorporated, a financial accrual basis. Okay. Company have executed a construction project in more than 10 months. More than 10 months because the law has been given for 6 months. If this is more than 6 months, so it will be subject to tax in the UAE. It will be considered PE of the non-resident person in the UAE because the time is more than 6 months. Now we need to calculate the income of this PE in the UAE. We are not concerned with country and operation out of the UAE. We are concerned with the PE of the non-resident person in the UAE. The income is 44800. This is my accounting income. Gift to business partner. Gift is not allowed. It will be added back. Head office allocation of expenses. This is allowed because the expenses has been made by the head office and it is allowed. Sorry for this. Expenses made by the head office and this is allowed. 1.5 million allocation of expenses by the head office to the branch. This is allowed. Salaries and wages are allowed. Cost of goods sold is allowed. Dividend from the UAE company should not be subject to tax because this is a exempt income. 5 million. Then rental income from property in the UAE. This branch, that is very important concept. I have highlighted it here as well. Because if the non-resident person is generating any rental income from the UAE, that will be subject to withholding tax. The 0% withholding tax will be applicable. But it has been given in the law that income will be subject to withholding tax unless that is related to the PE of the non-resident person. But this relate to the PE of the non-resident person, so withholding tax provision will not be applicable. Normal laws provision will be applicable. This income will be subject to tax in the UAE. So my answer is coming. This is 5 million. Yeah, 5 million is your taxable income. You need to apply the tax. But this is over from my side. And if you have any question, you are most welcome. I think we have missed one part of the case study, and we've always missed the second year in the case study as well. At least it will be quite helpful. I believe it will be a little bit helpful for you to go through the guide. If you have any question, you can speak to me. We can discuss it in detail then. Okay. Okay. Any question? Zoom. Okay, the first question is, do we have to get tax certificate to claim foreign tax credit? If you wanted to get the foreign tax credit, for sure you will be liable to register for corporate tax. You will be liable to submit the return. While submitting the return, you will be able to only claim the foreign tax credit. Otherwise, you cannot claim foreign tax credit. So you will be required to get the tax registration certificate. I believe you are asking the same question, tax registration certificate, not the tax residence certificate. In case you are asking for the tax residence certificate will not be required. You will be proof that your income, your company is out of the UAE, that company is subject to tax. Tomorrow, FTA or authorities in the UAE, they can ask for this as well. You need to bring any evidence that your income is being subject to tax. If they are asking, then we need to bring it. By the way, in the law, it has been given, we need to prove it that income is being subject to tax there. I believe your some extent might be they will ask you to bring the certificate as well, but they have not mentioned very clearly. They mentioned you need to prove your income is being subject to tax out of the UAE. Wasim is asking, can we discuss this example next week? I think this example we have sorted out. I apologize for this. I have taken a lot of time for this, but it has been sorted out. One thing is very important in the interest example. I just wanted to highlight, whatever is your carry forward interest, that interest will be considered while calculating the adjusted EBITDA for the next year as well. That is very important. Very important. I was making this mistake when I was practicing. I was going through this. So next year, whenever we are calculating adjusted EBITDA, you need to calculate the carry forward interest as well. Okay, guys, thank you very much. For how many years losses can be carry forward? Unlimited period of time you can carry forward the losses, but 75% of the relevant taxable income. Losses you can carry for unlimited period of time. Interest you can carry for 10 years. Any other question? No? Okay, guys. Have a lovely evening. Thank you very much. Thank you.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.